Hey, Dan Passarelli here. How you feeling today? I hope you're doing great. I hope you're doing super great, as a matter of fact. Today we're going to talk about maximizing profits, single-legged options versus debit spreads. Before we get started, I want to point out options are not for everyone. You should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. And everything we're doing here is providing generalized information not specific to your situation. Hey, Jan. Now, uh, everybody can hear me, right? Give me a big old yeppers in the Q&A box. All right. Thanks, Nitish, Justin, Gene. Mean Gene is here. Tomas. Uh, Yod. Hope I said that right. Greg. Jason. All right. You guys are awesome, man. You're fired up. I love it. I love it. For those who this is your first time listening to me, well, let me tell you who I am. My name is Dan Passarelli. Larry's here, of course. My name is Dan Passarelli. I am an author of two of the most popular option trading books, soon to have the third published. That's just about, oh my goodness, 6 weeks out. Do you believe that? And I write articles for some of the best publications on trading there is out there. Larry knows all about that. I'll tell you more about that as we get closer to the next great article for a great publication I have coming out. But yeah, I do a lot of online trainings just like these, do a lot of stuff. And why? Because I've been trading for a long, long time. Uh, I've been trading for a long, long, long time. Started trading back in 1990. Well, actually, started trading when I was in college in the right around 1990 or something like that. Geez Louise. Started on the trading floor in 1993, and I traded in the pits, wearing those funny looking colored jackets and all that business. And now I trade in a retail trading account, just like you. I am the president and founder of Market Taker Mentoring, which is the global leader in option trader education. We have thousands and thousands of students in over 50 countries. And I collaborate with a lot of the good actors here in the options community, the great options friendly brokers like Firstrade, for example, and also most, if not all, of the options exchanges out there. I end up not being totally sure because, they're, well, doesn't matter. Most of them. Um, so I have been around the block working with lots and lots of people. And I do other things besides trading. I am a family man, married to my wife, Kathleen, who many of you know. She runs operations here with Market Taker Mentoring. My two adult children, my two little tiny runt dogs every once in a while you see because they're trying to sit on my lap during my webinars. And I do other things besides all that. I'm a runner, foodie, traveler, musician. Um, what's the best way to purchase your new book coming out in April? Greg, it's gonna be, I'm actually gonna have, are you gonna be here next week, Greg? I'm gonna have a wait list ready next week. Make sure you mark your calendar, and I'm gonna tell everybody how to join the wait list so that you can be the first to get my new book as soon as it's out. All right. So enough about me. Let's talk about the important person here. Let's talk about you. I'm going to share lots of great stuff today that is going to help you get from where you are as a trader now to where you know you can be as a trader. And that's really exciting. After today, though, you should continue your training. The more you learn, the more you earn. So go to markettaker.com. That's two T's in a row, markettaker.com, and click on the top right, join free here. And that will get you lots of free education. Super great for people who are new to options. Also great for people who are experienced with options. As a matter of fact, tomorrow I'm doing a special online training webinar on a new indicator that I developed. Super, super excited about that. So if you click on join free, we'll send you an email, show you how to register for that. All right. So look, why do we trade options? Right? I mean, there's some more moving parts than there are with just trading the stock or ETF or futures or whatever. Why do we trade options? Well, because we can get advantages that we can't get from buying and selling stocks or ETFs or futures. We can get a lot more leverage, and we can do it with limited risk. This is what we're always trying to do. Protect our capital, limit our risk, and make as much as possible. Get leverage. We need to benefit from both of those things. Those are the only two jobs you have as a trader. And so we need to optimize that, right? I mean, we could limit our risk by putting our cash in a fireproof safe and just walking away. You just lose on inflation, right? You could buy treasury bonds, but you're going to underperform everybody else. You get tons of leverage, but if you're wrong, you lose a lot. We need to find the sweet spot. And the simplest optimization is, should I trade options or should I trade the stock? And if you're here listening to me, who is known in the options world as being an expert, then you probably gotten some experience with options. And it might have gone okay. It might have gone pretty good, or it might have gone bad. But here's the thing. You're here because you can always do better. Heck, I've been in options for 34 years. Oh my goodness, do you believe that? Been in options for 34 years. And I am always striving to create better techniques, better tools to make my trading better. Because if you're not moving forward, you're moving backward. So, and that's why you're here, right? You know that. So instead of just, do I trade options or do I trade stock? We need to take it a step further. What sort of options do we trade? Should we trade outrights or spreads? Well, let's explore that. Outrights is the common terminology for just buying a call or buying a put. But then spreads, and that's a single leg. Yeah, ones that make money. Yes, Larry. Yes, that is the rub, ain't it? So you can also call outrights single leg options because it's just one option. But there's another way to do it, and that's by using spreads. A spread is when you buy one option and sell a different option. And what's better, single leg options or spreads? Look, each of them have their own advantages. Each of them optimizes the risk versus leverage situation a little bit differently. So, geez, how do we know which one to use? Well, basically, the market tells us. We just look at the situation and we see, is this situation better for outrights or is this situation better for spreads? So let's zoom in, narrow this down just a little bit. Single leg options, again, buying a call or buying a put, they have limited risk and unlimited profit potential. And so what that means, if you think about it, is they benefit from volatility compared with just buying the stock, if we're talking about calls. Shorting stock, we're talking about puts. Why do they benefit from volatility compared with trading the stock? Well, because they have unlimited profit potential, just like a stock, but the downside is capped, unlike a stock. I mean, technically the downside is capped with a stock, but it's a pretty big downside. If the stock goes to zero, which doesn't happen every day, but if you've never seen it happen, you haven't been trading long enough, because you will, because I have seen it. It happens, not every day, but regularly. So single leg options are the best choice when you're expecting a big move, trading a breakout strategy, very, very strong momentum trends, any reason where you think that the stock could make a big move and experience volatility. And then there's debit spreads. Debit spreads, because we're buying one option, buying one option just like with the single leg options, that's buying one option, right? Well, we're basically doing that, but also selling another option. So if you think about it, because we're paying the same amount basically as a single leg, but then also selling an option, taking in some premium, we're paying less for debit spreads than we do for single legs. So that means we have less risk. And to boot, we actually might even have more profit potential with debit spreads. Now, this is kind of getting interesting. I have might in all caps there because it's not always the case, but sometimes it is the case. When is it the case? Well, debit spreads are the best choice when expecting limited gains in the underlying stock or ETF. The trend is expected to be limited by support if we're talking puts or resistance when we're talking about calls. My friend Jason here says, is that overall for average investors that debit spreads are more commonly chosen, while the comparably less profit expected also on average? Good question. And actually, right now is the great time to address that. I would say that the more experienced you are as an option trader, the more likely you are to trade debit spreads, but not always. That is what this whole training today is all about. When should you choose single leg and when should you choose debit spreads? Because, you say, well, comparatively less profit expected. Sometimes it is less profit, but strangely, sometimes it's actually more profit. So yeah, hold that thought. Let's talk about single leg options first here. So we're talking about breakouts. which is like when a stock maybe crosses above resistance or below support, breaking out of a range that it's been in. Maybe even event trading. There's a lot more to event trading than just looking for a breakout. Excuse me. We have to consider volatility and such, but that kind of plays into everything we're talking about here today and next week too. This is actually a two-part class, by the way. Momentum trading can be good for single legs too. That's when but momentum trading when we have very strong trends. The RSI is high, but not in overbought territory. Maybe ADX is high. Maybe we have definitely we have higher highs and higher lows. We have moving average crossovers indicating that the trend is strengthening. Another thing when it comes to single leg option setups is we don't want to see resistance. Now, I'm specifically talking about calls here for this one. We don't want to see resistance, which can restrict price movement, right? Because when stocks hit resistance, what tends to happen? Oh, they come back down. That's what resistance means. It resists the stock from going higher. Or maybe resistance is really, really far away. 9 months ago, it established resistance, but it had a pullback, and now it looks like it's climbing back, but resistance is still far away. That could be a scenario where we want to consider using single leg options. If we're expecting a fast move because of theta, single leg options are better because we can overcome theta by delta. If it's a slower move, then theta can eat up a lot of delta profits. There's a lot to think about here. Another thing, when we're only buying an option and not buying one and selling another, we have a lot of implied volatility risk, which is measured by what? Which option Greek measures implied volatility risk? Who can tell me? Oh, you knew I was going to ask. Did you know I was going to ask? Yeah, boom, Greg, first on the button. Ba-ding! Like Family Feud over here. Greg, good job. Nitish, good job. Jan, good job. Justin, good job. Eduardo, good job. Vega, yes, we have our Vega risk is big with single leg options, so we need to pay attention to implied volatility. We can only trade single leg options when implied volatility is low. Gosh, we better do a quick volatility review here, huh? With option trading, there are two types of volatility that we need to concern ourselves with. Realized volatility, which is basically the volatility you think of when somebody says the word volatility. The chart is whipping around all over the place. You see big price swings. It's how much the underlying stock has moved around lately. How do we measure that? Well, it's the annualized standard deviation of technically daily returns on the underlying. We might also call realized volatility historical volatility. In some circles, it's actually even more common to say historical volatility. But there's another type of volatility that we option traders need to concern ourselves with. And that, friends, is implied volatility. Implied volatility is just how cheap or expensive options are. That's it. Now, technically, mechanically, the textbook definition of what it is is it's the volatility figure that when entered into an options pricing model yields a theoretical value reflecting current market prices. Gosh, why didn't I just lead with that one? Well, because it's a big mouthful, right? It's how cheap or expensive options are. But the important thing here is that it's also stated in terms of annualized standard deviation. So we can use implied volatility and realized volatility together to do a few things. Some people use it as the market's estimation of the future volatility of an asset. There's something to that, but there's some problems with that statement too. It's the volatility implied by option prices, which is why it's called implied volatility. But really, if you just think about it as high implied volatility, expensive options, low implied volatility, cheap options, you're miles ahead of most traders out there. Natish. Is that how I say it? Natish or Nitish? Natish. Okay, good. Good. I like to try and pronounce people's names correctly. Is the slide deck downloadable? If so, from where? No, my friend, I am terribly sorry. It is not. You can take screenshots. I can't stop you from doing that, but I don't make them downloadable. And, you can always go back. One thing first, of the many things Firstrade does an excellent job with, one of the things is they archive all of these webinars and they put them on their YouTube channel. So if you just go to YouTube and search Firstrade, you're going to find them. You're going to come across them. You are welcome, my friend. All right. So volatility in long options. We want to buy options only when they're low priced. Wow. Am I saying something profound there or what? If I want to buy anything, I only want to buy it when it's low priced, right? If I want to buy a stock, do I buy it when it's really expensive or do I buy it when it's low priced? If I want to buy a car or a house or, some steaks to grill up for dinner, do I want to buy them when they have a high price or a low price? Low price for sure. Thank you. So it works that way with options too. And because there are a number of moving parts to options, like when the stock goes up or down, calls and puts gain or lose value. When time passes, calls and puts lose value. When implied volatility changes, calls and puts change value also. There's a little bit more to pay attention than just buying a stock, but it's worth it. You get so many advantages when you pay attention to this stuff. So how do we use volatility to understand when options are low priced or high priced, when they're cheap or expensive? Well, when implied volatility is below historical volatility or realized volatility, that's one indication that options are cheap. When implied volatility is in the bottom half of its 6-month range, that is one indication that options are cheap. So when implied volatility is low by those two measurements, and there's a little bit more to it also, but that's a great head start. When implied volatility is low, that's good for buying options because you're buying something that is cheap. Now, you still need the stock to go up if you're buying calls or down if you're buying puts, but you're giving yourself a little bit of a head start, a little bit of an advantage when you're buying them when implied volatility is low. If implied volatility is not low, then you're going to have to consider a different strategy. Otherwise, you're putting yourself at a disadvantage. We always want to choose the best strategy for the setup. So like I said, we've got theta risk, right? We're buying options just buying an outright single leg option, we get a big theta. We lose a lot of money as time passes. We have big vega. We make money if implied volatility goes up. We lose money if implied volatility goes down. That's why I want to start when it's down. And the strike proximity. When the stock price goes up, those calls gain in value. When it goes down, they lose in value. The opposite for puts. So we need to always think about these things. This is why my first book, Trading Option Greeks, was written. Because if you're not optimizing these things, you're never going to make it as an option trader. You're relying on luck and not skill. And that is not the way to do it. We need to rely on skill. So we should match the strategy specifications to the forecast. We need to think about which expiration is best. Timing is everything, as they say. But in options, it's not everything. It's one of the things. We also need to consider what's strike price. This is, again, single leg options we're talking about here. So for a long call or a long put, different expectations require different strategies. So let's look at momentum trends and breakouts like we've been talking about. Let's start with momentum trends. So here, let's say we are in an uptrend. The stock is setting higher pivots, which means higher highs and higher lows. What does that mean? I remember when somebody first told me higher highs and higher lows, I scratched my head. I was like, what are you talking about? Well, when a stock is going up, it doesn't just go straight up every day. It's not just a straight line. I wish it was, but it goes up and then it pulls back and then it goes up more and it pulls back and then it goes up more and maybe it pulls back a lot, but then it goes up even more. The highs, it makes a new high and pulls back. It makes a higher new high and pulls back. It makes a higher new high and pulls back. But what about those pullbacks? Well, those are a temporary low, but then it goes up, makes a new high, and then makes a higher temporary low. Makes a higher new high and a higher new low, a higher new high, higher new low. That is an uptrend. That is momentum and how it looks in real life. Look, man, when it comes to option trading, you need to understand option theory, but you also need to understand reality. If you're going to be good at this, it is my job to make it real for you. So that's what it really looks like in real life. Now with a downtrend, momentum downtrend, then we're setting, a new low, but then, maybe it's going to go back up. Nope. Going to go down more, a lower low. And then, it goes up again, but it's that temporary high is a lower high than the previous one. Now a lower low than the previous one. Now a lower high than the previous one. Lower low, lower high, lower low, lower high. And that's what a downtrend looks like in real life. See? Higher high, higher low, higher low, higher low, higher low, higher low, higher low, higher high, higher high, higher high, higher high, higher high, higher high. This is real, right? A steady trend with momentum. We want to capture that trend over time, and we don't want to get shaken out by like, oh no, it's going back down. What am I going to do? No, that's normal. We want maximum participation in this trend, and we want to be confident in its continuation. So we need to not just have a false sense of confidence, we need to have numbers that prove it to us. And we need to use the right option strategies. So with momentum trends like this, we're best served by using in the money calls. These are high delta calls, calls that have a delta between 70 and 90. These are a stock substitution play. We're just using the calls because we want to get more leverage. And if it's, a momentum trend, this is not like a 2-day trade. We're looking for stocks that we think are going to continue higher over the next month or 2 or 3. Momentum. And so we're going to choose options that have 2 to 6 months until expiration. Now, wait a minute. You're probably thinking, did I hear Dan say that right? We're looking for stocks that we think will continue higher for a month or 2 or 3, but we're choosing a 2 to 6 month option expiration. Those are different, right? Right. Why? Because here's the thing. Options that have a little time till expiration, they can have bigger thetas. It depends how close to the money you are. You can lose more on them. So we want to have a little bit longer term options, A, to give the trend time to play out, but also B, to have lower theta. So what are we doing here? We're having big delta to make money on the stock moving, low theta to not lose by time passing, and also to have low vega, less implied volatility risk. We're just getting leverage with this. Now, in the money calls, they're lower strikes, so they cost more. So we're actually risking more than an at the money or an out of the money call, but way, way, way less risk than buying the stock. And because it's in the money, we have low theta and low vega. It's just a delta play. It's a stock substitution play. So the benefits here are, because it has a big delta, it moves more in step with the stock. Stock goes up by $1. The call might go up by 80 cents. That's good. Time passes, we don't lose that much with theta. Implied volatility changes, we don't lose that much with vega. We've got plenty of time for the stock to climb because we choose to buy options with extra time till expiration for all these reasons. But the detriments, they talk about double-edged swords. Well, it moves in step with the stock. If you're wrong and the stock goes down, you lose more, right? Theta and vega are still there. They're small, but they're still a thing. Okay. So now let's talk about breakout strategies. So this is a different thing. Sometimes a price moving through an identified level of support or resistance gets follow through. A lot of times we want to look at the volume along with that. Does volume increase? If a stock breaks through resistance on increased volume, there's a good chance you're going to see follow through on that. That's called a breakout. When breakouts work, they can really work well. But the problem is, a lot of times they fail. I would say it depends on how strong your criteria are. But for most traders, most breakouts fail. So we really need to have good criteria, and we need to do other things to put the odds on your side. So this is what our head coach, John, here calls a 2-bar break. That's a break of support or resistance that has two bars, or really two candlesticks is the way I like to look at it. Two candlesticks breaking through. So that's two consecutive closes, either below support if it's a downward break, or above resistance if it's an upward move. So look, when you see your candles, this is what you want to see. Like, okay, here, this line is resistance. Well, okay. This line is resistance. Okay, close below it, but we got to break above resistance. Now, we don't get super excited just yet. We want what is called a confirmation candle to complete our two candlestick breakout. It closes above it today, but tomorrow, boom, it also closes above it. That's going to be a much, much stronger signal. But with options, we don't always need stocks to go up when it comes to options. We can have some great trades that are on stocks that are going down. In this case, a stock that breaks through support. So here the stock is, trading, and then it falls down through support, closes below support, and then the next day also closes below support. That gives us a strong signal where we can buy puts maybe and make money on that. Now, candlestick failures are the problem. The follow-through failures. Candlestick fails to close above or below support or resistance, or closes once but not twice. We always want to make sure we get that second candle, that confirmation candle. Oh, do I factor in the wick in the candlestick? Not really, Susanna. Not really. You know, it's kind of messy. Trading is kind of messy, and we have to respect that, like when I cook, if I know I need about a teaspoon of salt, I'm going to put it in my palm of my hand, and I know exactly what a teaspoon looks like, Now, when I say exactly, could it be a couple of grains of salt more or a couple of grains of salt less? Yeah. Either way, it's going in the, marinara or whatever, right? That's kind of like the wicks, like you can't exactly pinpoint to the penny support or resistance. So I don't put as much stock in the wicks. Right. What about for day traders and confirmation candles? On which time frame? Well, I mean, it's a little hard to day trade with options. I'm not going to say, it's impossible, but it's harder because of the bid-ask spreads. But for day traders, breakout and confirmation candles on which time frame, I honestly don't do a lot of day trading with options. So I'm probably not the best person to ask, but you're probably looking at 1 minute or 5 minute candles. All right. So now we're looking at something different. We might get those higher highs and higher lows. But what we're really talking about is bing, this. We can draw kind of a resistance line across here. And, I just put lines here. I didn't actually make them open, high, low, close bars or candlesticks with bodies and wicks. I'm just trying to simplify. So yeah, give me one quick second. All right. So let's say we're looking for a breakout trade. Okay. We got something that looks like what I just showed you. All right. Well, the at the money or out of the money call is what we're going to want to look at for here. Now, that's different than those slow momentum trades. Okay. Here, we're actually getting a smaller delta, a 50 delta for a minor breakout, which is an at the money call, to the upside or put to the downside. If we're expecting just a huge breakout, like a major gap or something, then I'm actually going to want to use an out of the money call. So, that's interesting, right? It's different depending on what you're sizing up here. Slow moves, slow momentum trades, in the money, long-term call. A breakout trade where we're looking for, this quick pop over a period or two or five, at the money or out of the money call, because it's a leveraged speculation play, and 2 weeks to a month until option expiration. But we're probably only going to hold it for 1 week or even less. Here, we're definitely buying extra time because why? Because the theta is going to be bigger on at the monies. Or if it's an out of the money and close to the money, the theta is going to be bigger. And either way, we're not looking for a steady grind. Well, if we identify a stock like this, we're not expecting a steady grind higher. We're expecting a big pop. So we're more willing to accept theta here, but we still want to minimize it. We still want to buy a little extra time to keep that theta small. These trades, at the money or out of the money calls with a 2 week to 1 month until expiration, they work best on breakouts. We risk less than an in the money call because they're going to fail more than the ones that are making higher highs, higher lows. But why are we willing to accept less delta though? Doesn't that seem weird? Like, don't we still want a big delta? I mean, in a perfect world, but we're trying to maximize all of our trade-offs here. We want to get lower theta, but we're accepting higher theta and we're accepting higher vega because we think it's going to be a quick play. So, okay, back to the delta again. Why are we willing to accept a lower delta? Because we also get higher gamma. What is gamma? What is gamma? Gamma is how much the delta changes. So look, if we're looking at an out of the money call, maybe the stock's at 100 and we buy the 105 strike calls. Maybe that has like a 35 delta only. That means the stock goes up $1, the option only goes up by 35 cents. But here's the thing. If the stock shoots up because 100 is resistance and it breaks up to 110, 115, something like that, the delta is going to go from 35 to like 70 or something like that. The delta is going to change and it's going to become in our favor. So what we're really balancing out here is risking less than an in the money. And even though our delta starts out small, it gets big. See, like these moving parts are kind of cool, aren't they? So there's some detriments and benefits here. Benefits, we get awesome leverage, and it's the gamma that gives us that leverage. There's low capital at risk. It costs very little to buy these at the money or out of the money options, but they've got a little delta that becomes a big delta. Now the vega can be higher too. So like sometimes people say, okay, well, Dan, how about options that are right before earnings? Like that could be a breakout, right? Well, we still want to look for cheap volatility, which you seldom get going into an earnings event. So there's some detriments here too. Some people will use the delta as the likelihood of an option expiring in the money. Now, does an option have to expire in the money to make money on it? No. I mean, we're not going to hold. I almost never hold options until expiration. I do some, but they're rare covered call or cash secured put trades on illiquid stocks. um, so yeah, there's a low probability of success because they have a lower delta and because not all breakouts happen. I mean, man, if I could predict with 100% accuracy when a stock is going to do this, break out like this, goodness gracious, we would be having this class on my yacht. But we're traders. We're not psychic. We can't see the future. When with trades like that, they have a lower probability of success, and that's okay. I mean, I know a lot of traders who live in big houses and drive nice cars and have great financial lives when making trades where most of them are losers. But you have to lose a little bit on the losers and make a ton on the winners. So it's okay to have low probability trades if you're choosing the right way to trade it. Theta always eats away at long options. It is a detriment. It is something that hurts our trade, but these are short-term trades. And we're buying extra time. So the whole option premium is not getting eaten up by theta, right? It's not getting eaten up by theta because we're only going to be in the trade for a short period of time. And Vega also, we still want to do that volatility check always. Now, I think you're probably picking up on the concept here that the option Greeks determine which strategy is better. Why did I write a whole entire book on just the option Greeks? Because they're really gosh darn important. You cannot make money consistently in the long run without being good at using the Greeks if you're an option trader. Anybody who tells you any different, anybody who thinks any different, they're lying to you or you're lying to yourself. Trust me, I've spent a lot of time in the options game. It's all about the Greeks, friends. So we need to optimize our delta on every trade, our theta on every trade, our vega on every trade, which means optimizing implied volatility on every trade, and the amount of capital at risk on every trade. So let's take scenario one, not considering all the Greeks. Okay, hey, I think that the stock is going to go up, probably like a momentum trade. And it does. It grinds a little higher, goes up today by $1. Volatility is unchanged. Now, let's say I bought 10 of the March 150 calls. Originally at $18.75. And because they're in the money calls, let's just say, okay, they're in the money calls, let's just say, I make 92 cents because the delta is 92 cents. Okay. And, I mean, if it just pops in the first 20 minutes of the trading day, then I'm not going to lose anything on theta. Might not lose anything on Vega. That's all a delta play. Great. But is that something we can count on? Is that really realistic? Well, no. If we're talking about a momentum trade, it's probably more like the stock goes up a buck, it's $1 higher over 7 days or something. And implied volatility probably would have fallen 2 points because that's not a big move. And implied volatility tends to fall when stocks go up anyway. So a more realistic trade, if I originally bought this call at $18.75, it's in the money with that big delta. Well, I'd still have made 92 cents on the delta, but I'd have lost money on theta and money on Vega. So I might have either made less. Actually, looking at this is just like a 1 day thing. Like I probably would have actually lost money on it. Okay, so now let's look at it if we did an in the money call or an at the money call. Well, if we take into account the in the money call, we got a big delta, small theta, small Vega over a 7-day period. Where's my arrow here? 5 cents times 7 days, we lose 35 cents. Volatility falls 2 points. 7 times 2 is I lose 14 cents. So sure, I make 92 cents. I lose 35 cents. I lose 14 cents. I really only make 43 cents. With the at the money call, I'd actually have lost money on a momentum trade if I buy the at the money call. Why? Because the delta is smaller, but the theta and Vega are higher. So I only make 48 cents instead of 92 cents, and I lose 70 cents instead of 35 cents, and I lose 32 cents instead of 14 cents. I could be right. The stock goes up, grinds higher because it's a momentum trade, and I still lose money. So choosing the right expiration and the right strike price by using the Greeks and our expectations is the key to success. Now, if we're talking about a breakout trade here, one of those boom, quick pops, it rises $5, in a day or something like that, then the at the money call or maybe even an out of the money call are going to be better. So sure, we have a lower delta with the at the money and a higher theta and a higher Vega. But if it gets that big pop in one day, doesn't matter. I make so much more on delta. Well, I'm saying I make so much more, but do I? As a percentage, yes. Right? Because here I'm investing $18.75. Here I'm investing $4.15. I'm investing only a fourth of the amount with the at the money call than I am with the in the money call. So if I invest a fourth of as much and I make half as much on delta, even if I lose twice as much on theta and Vega, I still end up making more money. I make 48% with the at the money call versus 24% with the in the money call. So different scenarios require different types of options. Now, one thing we touched on some here, but not a whole ton just yet, is the implied volatility risk. Implied volatility tends to what is called revert to the mean. Implied volatility can go up, meaning options get more expensive, but it goes back down. In fact, implied volatility can get really cheap, meaning options are really cheap, but it tends to go back up. The mean or the average, it tends to move around higher, lower, but always reverting to that average over the long run. If it's high, it can fall, hurting the long call or long put. If it's low, it's less likely to fall, more likely to go up, which actually kind of helps the long call or the long put. Higher implied volatility also makes for higher theta. And we're going to talk more on that later, but later turns out to actually be next week, where we have part 2, and we're going to talk all about debit spreads, right? And we're going to talk about when to use debit spreads, when they're better than buying a call, when they're worse than buying a call, and how to maximize those debit spreads. Next week, friends, is a super, super important class, and show up. And by then, I'm going to have you able to sign up for the waiting list for my upcoming book, which is pretty darn exciting. Yeah, thanks, friends. All right. I will catch you next time. Have a great rest of your day. This is Dan Passarelli, Trade Smart, and I'll see you in a week, 7 days. All right. Bye.